Hello, welcome to LCG's preview for the week ahead. I'm going to discuss the worst month for US stocks in 7 years, US midterm elections, and the Federal Reserve rate decision. Before that, I'll run down the biggest events in the economic calendar. On Monday, we have the China Caixin Services PMI and UK Services PMI. On Tuesday, there is the RBA interest rate decision and Eurozone Services PMI. On Wednesday, there is Germany industrial production and the RBNZ rate decision. On Thursday, it's the China trade balance, European Commission growth forecasts, and the Federal Reserve interest rate decision. And then on Friday, we have China CPI and PPI, UK industrial production, and UK third quarter GDP. Now, moving on to the top corporate results to watch this week. Marriott International reports Q3 earnings on Monday. Associated British Foods and Imperial Brands report full-year numbers, while Sky, Rangold, Ralph Lauren and Twilio report quarterly results on Tuesday. Marks & Spencer reports half-year results. BMW, Unicredit, Adidas, Michael Kors, Square and Weibo report Q3 earnings on Wednesday. Auto Trader and J. Sainsbury report half-year numbers, while Societe Generale, Commerzbank, Siemens, AstraZeneca, WorldPay, Dropbox and Walt Disney have their third quarter earnings announcements on Friday. So it's undoubtedly been a pretty bad month for US stocks. The rest of the world have been struggling for a while. US stocks caught up with a vengeance in October, which is known for being a particularly high volatile month. Obviously had some top stock market crashes during October in the past. Various black days have happened in October. So to some extent, seasonal factors involved here. Obviously, the market was rather overbought. So now that we have seen some of those top technology stocks down as much as 20% from their highs, and the S&P 500 down 10% from its highs, and indeed dropping below the 200-day moving average, some of that technical overboughtness come out of the market. So you could say for technical reasons, we'll probably do a little bit of a bounce coming into the start of November. But clearly some of the issues that the market's been worried about still very relevant. November as itself has a couple of key events. We've got the Fed meeting next week. Midterm elections are obviously next week, so we'll know what happens there. Well, I'll talk about that in just a moment. And then probably the next risk event is the G20. And I think arguably what the market was doing when it was turning down in October was a lot of investors jumping out before some of these risk events that are occurring in November. So it remains to be seen how they pan out and whether in fact this drop in prices was just a temporary exit ahead of risk events and maybe people jump back in again as the events perhaps unfold in a more favourable fashion than is possible. Talking about specifically about US midterms, obviously the overriding factor is, well, okay, will the Trump agenda be derailed if the House and Senate are split, or indeed if in the unlikely scenario that both the House and the Senate go to Democrats? Obviously, that would be a tougher time for Trump to push through some of the things he's trying to do. Some of which are market friendly. So for example, more tax cuts potentially on the way, so more geared towards middle income families rather than corporations, which was the first bout of tax cuts. Obviously not such a direct benefit for the stock market, but if it did increase consumer demand in what is already quite a healthy economy, that would obviously feed through to the corporations through high demand for their products. Deregulation, particularly a factor for the financial sector, that would be of benefit if Trump stayed in. But obviously the big factor that has been a negative under Trump has been the trade war. Potentially if Trump was left by himself in the White House with Democrats in control of Congress and the Senate, maybe he'd have a little less power to push through some of these ideas on the trade war, might be a little bit more forced to come to an agreement with China, which would probably, at least in the short term, be a positive thing for taking risk in the market. So all these factors at play when we're talking about these specific midterms, and why perhaps they're a little bit more important than usual with Trump in office and everything that he's trying to do. So switching gears to talking about the Federal Reserve rate decision. So no action expected in November. December really is the decision month because again, that's when the press conference is. So this month is all about the likelihood of the Fed actually following through with what is still expected to be a rate hike in December. Markets pricing about a 2/3 chance of a December rate hike, so far from fully priced in. And there's in fact not consensus within the FOMC members themselves. 4 members, as we knew in October, were still not expecting a December hike. So we think probably net the rate hike does happen in December. But the question is more uncertain going forward, obviously. The dot plot, which is how the Fed members pinpoint where they think rates are going forward, and obviously rising interest rates have been a big concern over the last month or so. Dot plots pointing to rates topping out around 3 to 3.5% in 2020 and then declining from there. So a little bit unsure what the Fed is trying to signal to us there. Normally you would expect in a strong economy for interest rates to somehow hit around 5% before the Fed decides to ease off on that hiking rate. So clearly a kind of shallower path of rates expected from the Fed. Maybe they're not as confident in that underlying economy. And last but not least, I just wanted to quickly mention at the end that interesting price action in the Forex markets. This is more of a technical idea, but there seems to be a bit of a double top taking place in the US dollar. It's just particularly interesting. It's only got a couple of days behind it, but the price did reverse very close to the previous midterm peak. And we saw similar action in the pound, where cable bounced off its recent lows to form a double bottom, and the same thing in the euro. So euro also bounced off its near-term lows. So potentially something in that. I think probably the big drivers for the dollar at the moment is its ability to be a haven in times of uncertainty, i.e. a stock market crash or a trade war, etc. And then more specifically about the trade war, if it turns out that actually Trump and President Xi from China come up with something a bit more conciliatory at the G20 in a couple of weeks, then that inflationary effect of the trade war, not such a factor, and less need for a haven again. So then again, less need for the dollar, potentially leading to some sort of midterm dollar top. Well, thank you very much for watching. Good luck trading this week. And if you want to see these videos as soon as they're released, please follow LCG on YouTube and social media.